The stock market is turbulent, prices are falling, and your portfolio is probably deep in the red. But what if I told you that moments like these are where the biggest opportunities are born? A crisis doesn't just test your nerves, it can actually boost your long-term returns. In this video, we'll dive into how crises really affect your portfolio, how long they usually last, and why younger investors in particular should almost hope for a crash. So, stick around if you want to turn market setbacks into a powerful advantage for your wealth. If you're invested right now, you're probably not having a great time. Since the start of the year, stocks have dropped, and a quick rocket-like recovery doesn't seem likely. But anyone investing for the long haul has to expect these turbulent phases, and honestly, it's not as bad as it seems. In fact, it can be a decisive advantage. As finance expert Gerd Kommer once said, young people should almost wish for a stock market crisis because in the long run, it works in their favor. Sounds crazy, right? Let's break it down. To understand why crises aren't always bad, let's look at the long-term picture. Take the MSCI World Index, which tracks major global stocks. Since 1977, it has grown by an average of 10.2% per year, including reinvested dividends. That sounds incredible, but it's only half the story. That figure covers over 40 years, with amazing highs and brutal crashes. Not a single year ever hit that exact average. Some were way higher, others were deep in the red. Now, let's look at a more recent period, from 1998 to mid-2022. Over these 25 years, the MSCI World delivered an average return of 6.7% annually. Still solid, especially when you consider that after inflation, it was about 5.1% in real returns. But here's the key, those 6.7% are just an average. No investor ever got exactly 6.7% each year. The actual results varied wildly. So what does that mean in practice? Between 1998 and 2022, there were years where the MSCI World returned over 20% real party for investors. But there were also 7 losing years, some with double-digit losses. And that's the point. Stock market returns don't move in a straight line. They come in waves, sometimes up, sometimes down. Beginners often hear 6.7% and imagine their money growing steadily, like a savings account. But that's not how it works. In the short term, the market is unpredictable, almost random. Over the long term, however, it follows a clear upward trend. Now, for the exciting part, how do crises actually affect your wealth if you invest regularly? Let's imagine you invested €10,000 every single year since 1998 in the MSCI World. By the end, your portfolio would be worth about €673,000. Of that, roughly €423,000 would be pure profit. Not bad at all. But the journey there was anything but smooth. In years like 2001, 2002, or during the 2008 financial crisis, your portfolio would have been bleeding red. In 2008, for instance, your portfolio's value would have plummeted from around €160,000 to under €100,000. Psychologically, that's brutal. But here's the hidden advantage. You kept investing your €10,000 each year, but at much, much cheaper prices. And those low entry points supercharged your returns for years to come. Let's revisit that 2008 financial crisis. The MSCI World plunged by 40%. A €160,000 portfolio suddenly shrank to under €100,000. A total shock. But now, imagine that same crash didn't happen in 2008, but right at the beginning of your journey in year one. Your first €10,000 would have instantly dropped to €6,000. Painful, for sure, but you would have kept investing every year after that. The result? Instead of €673,000, your portfolio would have grown to €948,000. Why? Because you spent almost your entire savings period buying in at much cheaper prices. You'd have built up €275,000 more wealth, and your personal return would have jumped from 7.4% to 9.8% per year. The lesson here is that an early crash feels terrible, but it can be a massive long-term advantage. This example highlights a critical principle: the sequence of returns risk. The average return from 1998 to 2022 was 6.7%. That didn't change. We only changed the order of the years, and that alone made all the difference. Your personal outcome can be completely different depending on when the good and bad years happen. So no, it's not irrelevant when crises strike, especially if you're using a savings plan. Now, let's flip the scenario. Imagine the best stock market years happened first, and the bad ones only hit at the end of your investing journey. Your portfolio would look like a dream come true. Within a few years, you'd be sitting on nearly €900,000. You'd feel like a market genius. But then the bad years hit right at the end and wipe out a huge chunk of your gains. In the end, you'd be left with just €246,000. Your personal return, a miserable minus 0.1% per year, and that's with the exact same 6.7% average annual return. This is the dark side. Late-stage crises can absolutely destroy your portfolio's growth. There's one more scenario, the mathematically optimal but psychologically brutal case. Imagine all the crises happened right at the start. For 11 straight years, your portfolio would be in the red. You'd keep wondering why you were even bothering to invest. But if you held on, the payoff would be massive. After 25 years, you wouldn't have €673,000 or €948,000. You'd have a staggering €2.5 million. Your personal return would be an incredible 16.3% per year. But who can mentally endure seeing losses for over a decade? So, what's the takeaway? The average return is just a theoretical number. Most people invest gradually, and what really matters is your personal, effective return, also known as the internal rate of return. This is heavily influenced by the sequence of returns. That's why the timing of crises is so important. Early crises are actually beneficial for long-term savers because they let you buy more shares on sale. Late crises, when your portfolio is already large, are far more painful. For younger investors, this means that even if it hurts now, an early crash is a gift. The biggest challenge is psychological. Seeing red can be discouraging, and many people give up right when they should be staying the course. So, how long do these crises actually last? Looking at the MSCI World since 1977, we can see 6 major crises that took over a year to recover from. For example, during the dot-com bubble from 2000 to 2003, the market fell 48% and took 6.6 years to fully recover. The 2008 financial crisis saw a 55% drop and took 6.4 years to bounce back. There were also smaller ones, like the 2020 crash, which recovered in just 7 months. Most crises last 1 to 2 years on the way down, but the recovery can take several years. The key is that your portfolio isn't in the red that entire time. During the recovery, prices are already climbing, and those cheap shares you bought start to grow. Stock market crises feel painful, but they are temporary. So, what should you actually do during a crisis? First, the don'ts. Don't panic sell. Selling at the bottom just locks in your losses. Don't stop your savings plans. Crises are when you get the best deals. And don't constantly change your strategy. Now, for the DOS, check your portfolio less often. It sounds simple, but it keeps you calm. Review your asset allocation to make sure you can sleep at night. And most importantly, think long-term. Real wealth is built over decades, not in a single year. Let's be clear, no one likes a crisis. But when they happen matters. At the start of your journey, they can help. Your contributions have a bigger impact and can offset losses. At the end, when your portfolio is large, they cause more damage because new contributions are just a drop in the bucket. This is especially true if you're nearing retirement, which is why you should gradually shift to safer assets as you get older. Crises are unavoidable, but they aren't the end of the world. They're part of the game. If you're young and investing regularly, a crisis is an opportunity. You buy low and your wealth grows stronger over the decades. The most important rule is to stay in for the long haul. Avoid panic, stick to your strategy, and don't let the red numbers scare you. In the end, patience is rewarded. You might even look back one day and say, that crisis was one of the best things that ever happened to my portfolio. If you found this video helpful, I'd appreciate a thumbs up. Let me know in the comments how you're handling the market volatility. And if you're new here, be sure to subscribe so you don't miss our future videos. Thanks for watching, and I'll see you in the next one.